Now with this video, we are going to just continue to build onto our ability to calculate risk, understand risk, and just keep adding more and more layers to it. In this, we're going to calculate risk for entry and exit points. Key point being, does it make sense to hop in here? Is it a logical area to maybe take some risk with my money at this location? Now this may seem obvious, but just my experience in the penny stock world, and a lot of people don't consider this, but this is the most important thing out of anything we've talked about when it comes to risk. And I'm not going to be doing the whole save the best for last. I'm going to address this right now because this is the verification step that needs to be done, because if you don't do this, then nothing else matters. And I don't want you to waste your time. You don't want to waste your time. So let's start with this. And everything we've talked about in the course up until now, this is the step that you need to do first. If it doesn't pass this step, then don't even bother doing any of that other stuff, because none of it matters until this step can be met and verified. So what is this big step? I'm building this up, and it's no matter, I don't care who the company is, who told you about the company, what you think of the company. The question is, what is the deal flow situation for the stock? Now, just a quick reminder, a deal is, remember, the deal is what's on the tape, and a deal is when an agreement is reached between the buyer and the seller. So what kind of deal flow is going on for the stock? What's that situation? What's that kind of context? Is just the deal. We've been talking about a lot about context, but what is the deal flow like? This is the most important thing. Nothing else matters. I want to drive that home. You're going to be wasting your time if you skip over the step or forget it, or don't take it into consideration, because if it doesn't meet what it needs to meet, and if you aren't able to put the little check mark in the box next to this step, then you don't even need to bother doing anything else, because you're wasting your time. So let's break down deal flow a little bit more here. There's two sub questions when dealing with deal flow. That's kind of a mouthful. Question number one is, what is the total size of the deals being made? Question number two, what is the rate of the deals being made? So our two important distinctions here are the size of the deal and the rate. How fast or how slow are the rates actually going? So let's talk about total size. What is the total amount of shares that have reached an agreement to be bought or sold? In just trading lingo, that is what volume is. Again, I'm going to say that. What is the total amount of shares that have reached an agreement to be bought and sold? So going way back to one of the first videos with the picture, they got the guy up on stage. Yeah, I'll give you 25, 25, 35, 35, going all that. Then you got the people out in the audience raising their hands. I'll take it, I'll take it. What sort of size deals are being agreed to there? This can be found by looking at the scoreboard section of that level 2 platform. So we'll get to the scoreboard section quickly. You will also need to know the lowest price of the day that a deal has been agreed to. So again, there's been multiple deals, but what is the lowest price that a deal has been made? In stock trader lingo, that is just known as the low of the day. So just to sum things up very quickly, the two things you need to know about the deals are the volume and the low of the day. Now, most level 2s have them. I suppose I've seen some that don't have them. They certainly all come in different forms, but the scoreboard, as I like to call it, is just a quick summary of what's going on. So, just looking at this scoreboard, they're giving us the inside bid, the inside ask. So there's the bid-ask spread. They're giving us, how much it's changed. They're giving us the high. So the most any agreement has been reached on the day for this is $43.51. But the two key numbers we care about are right here. The lowest price any agreement has been reached on the day is $42.87, and then the number of shares that have been agreed upon and transferred back and forth for the day, little over 1 million. So yeah, all are different, but at minimum you need one that quickly shows you these two numbers. All these are different, being just the level 2 platforms, the design of the levels 2s. Every broker, every service going to have their own little twist to it, but you need some sort of scoreboard that's going to at minimum give you these two numbers. So I just talked about this, but I want to put it more kind of clearly. So the size of the deals agreed to, the volume, a little over 1 million, and then the lowest price deal of the day was priced at $42.87. What the heck does anything have to do with calculating risk? Maybe that's what you're thinking about. Liquidity is the first issue that needs to be addressed in regards to risk. Liquidity. Learn to love that word if you've never heard it before. The highest risk you can take as a trader is putting yourself into a non-liquid stock. I bring this up, and the reason I'm really going to harp on it and slowly go through this is I was once talking with an engineering buddy of mine. He's much smarter. I mean, one of the more intelligent people I know, and he was telling me about, he's dabbling in the stock market, and he got into the stock, and now he's kind of he was describing it. Yeah, I got in, and the price went up, and but now I'd like to get out, but I mean, I'm really kind of having a hard time getting out. And I said, well, how much volume does it do? What do you mean by volume? And then we got into this whole discussion. What he had done was, very smart person, he had bought in a stock that had very little volume, but it was non-liquid. So now he was stuck in a liquidity trap. And that's what we want to avoid. We need to, priority number one, avoiding liquidity traps. That is just basic risk management. If you're putting yourself in a liquidity trap, I don't care how good the level twos looked or anything like that, because the scoreboard is telling you liquidity trap right now. I don't care what the level twos are looking like. So the best way we can just hedge our risk to begin with is by avoiding liquidity traps. This is why I'm a huge fan of big board stocks, because they are very liquid, as we're about to kind of see going through this stuff. So what is liquidity? Liquidity is the rate of speed at which an asset you own can be converted back into cash. An asset, well, a form of an asset is cash, but excluding cash, an asset is something that you need to try to convert into cash to bring about its true value. Now, let's just look at some examples. A very liquid asset would be when someone writes you a check, and let's assume they're not, they're good for their money. They're good with their money. They have a good reputation, so the cash is good, or the check is good. So one of these people write you a check. Right now, a check, you can't walk into a store and hand it to somebody. Hey, I'd like to pay with this. No, what do you have to do first? You have to go cash the check. Why do they say that? Well, because that is a process of liquidity. When you go to cash the check, you are converting that personal check, that piece of paper, into cash, and that's what you want. So it's very liquid, though. You go to the bank, boom, boom, happens instantaneous. You get your cash from that check. Now, something that's not liquid would be real estate. Now, a property may be worth a certain amount in theory. Your real estate agent may tell you, yep, this property is worth that. But until you can find a seller who agrees it is worth that particular amount, you cannot convert your asset, that property, into cash. So let's look at a best case scenario. Let's say, best case, you sell the house within 1 hour of being on the market. You list it with your realtor, bam, an hour later, hey, I got a call. They want to buy it for this amount. You sign up the paperwork. But that's the problem, the paperwork. So even in like a super, good case like that where it's sold within an hour, no, let's do this. It's sold within a minute. You put it on, bam, realtor call, 60 seconds later, hey, I have an agreement. Someone submitted an offer. You sign it another minute later, so 2 minutes total. The paperwork you've accepted their deal. However, there's more paperwork that needs to be done. So you're still looking at a minimum of 1 to 2 weeks before you can finally convert that asset into cash. Walk away from the closing table with a check. So then again, I guess there's a two-step process because you still have to go and convert that check into cash. But point being, it's not liquid. Real estate is not a liquid asset. So when people are talking about liquidity, it's all how fast can you convert an asset into cash. That is what liquidity is. So as traders, the longer it may take us to convert our asset, which in this case are shares, back into cash, the higher the risk rises. I want to say that again. As traders, the longer it may take us to convert our asset, our shares, back into cash, the higher the risk rises. So what am I saying here? We need to be able to sell. That's what I'm getting at in that point. If we're going to have a hard time selling our shares, we're going to have issues and the risk goes up very quickly. So let's hop back into our example here now that we have a definition of what liquidity is. The scoreboard's numbers, we already looked at that. Now to quickly estimate the liquidity of the stock, just use this equation. Volume times low of the day equals dollar volume, and dollar volume is liquidity. Now why do I choose low of the day? Well, I'm a big fan of just choosing worst case scenario and then basing decisions based off that. I don't like to choose a best case scenario would be let's use the highest price because that's going to give us the biggest number. Hopefully we all understand some basic math. the higher any of these numbers go, the bigger this number goes. So if we choose a higher number for low of the day, that's going to give us a higher dollar volume. But was every single deal agreed to at that price? No, it wasn't. It was agreed to at various prices. So I prefer to, you know what? Let's just take a worst case scenario. What was the least? Okay, I'm going to base the dollar volume or the liquidity, both the same thing, off of the lowest price of the day. Now we'll cover that in a little bit here. Actually, I'm just going to say it right now. The good thing about this is you don't have to pull out your calculator. Lots of platforms out there will calculate the dollar volume for you. A lot of them will show you the share volume, but we care about the dollar volume, and a lot will do that. But a lot of times it can just be the eyeball test, meaning, okay, 1 million shares, $42. Okay, that's a lot of liquidity. If you're curious about the number, basically $43 million. So knowing that the liquidity is, $43 million, there's been $43 million worth of deals that have happened. Let's say you want to put $10,000 at risk and then convert it back into, or you want to put $10,000 at risk and convert it into shares. Remember, when you're buying, you are converting cash into shares. So you have 10,000, you want to convert it into shares. The question to ask is this, very important question. Based on the dollar volume thus far, because let's say you're doing this during the day, what is the risk that going forward I will be able to convert my shares back into cash when I want to? How quickly will I be able to? Maybe this sounds very just simplistic, but it amazes me. I get emails every day from people talking about stocks, which why would you ever want to convert your cash into those sorts of shares? You're going to have a hard time cashing out. And being this course is all about risk management, this is at the core of risk management. Liquidity. We need liquidity. So again, that question, based on the dollar volume thus far or the average daily volume, you can also look at, how many shares on average does this trade? That's going to give you a good indicator. So on the average, based on the average daily volume, let me take a step back. If you are looking to buy the stock within the first minute of the day, obviously the volume might be a little bit lower. So you're going to want to look at what has this been averaging the past 3 or 4 days, especially in penny land. You want to know, I'd almost say basically the past 2 to 3 days. What's the average volume? So based on that, what is the risk going forward that I'm going to be able to convert these shares back into cash? Because it's fine. It's easy to be able to convert them from cash into shares. You just go and buy. I mean, penny stock CEOs, they love to take your cash and give you some shares for them. Financiers love to take your cash and give you some shares for them. But when it's time for you to convert those shares back into cash, are you going to be able to do that? And if so, how quickly? Okay, let's do a new example here. So here are going to be the scoreboard's numbers. The size of a deals agreed to, the volume, 1 billion. 1 billion shares have been agreed to in volume. Holy smokes. The lowest price deal of the day was at 0003. So now let's do the math. 1 billion times 0003 equals, wait a second, $300,000 in dollar volume. So let's go with the same assumption. You want to place $10,000 at risk and convert it into shares of this particular stock. Let's ask that question again. Based on the dollar volume or the average daily volume, what is the risk that going forward I will be able to convert my shares back into cash when I want to? How quickly will I be able to? In this scenario, is it impossible? No. But is it going to be much more difficult than the previous example? Absolutely yes. Therefore, this carries a much higher risk of getting yourself into a liquidity trap. Again, where you want to convert to cash but cannot. And this also brings up the example of why share volume does not matter. What is share volume in this case? Share volume is 1 billion. Does 1 billion sound like, oh, that must be super liquid? Yes, it does, but that's only half of the equation. That's only half of what we need. We need to know, what are these deals being, these shares are, yes, there's been 1 billion shares agreed to in deals, but what price? Well, if the low was 0003, that only equates to $300,000 in liquidity. I'm not going to call that a super small amount, but it's not a super liquid stock for an entire day. If there's only been 300,000, again, 10,000 you could probably pull out, but I mean, that's going to be difficult. It's going to take some skill, and it probably will have to be done over a couple of days if there's only $300,000 in volume. So don't go by share volume. If you're writing stuff down, write this down and highlight it and box it. Share volume does not matter. Dollar volume equals liquidity equals the thing that matters. So if you need to rewind and listen to that again, do that. But write that down and understand that we are in the business of needing to know dollar volume, not share volume. I don't care about share volume. I want to know dollar volume because that's what's going to tell us what the liquidity is, and the liquidity is going to tell us how much risk is involved. The more liquidity, the less risk there is, because it's going to be much easier to convert our asset, our shares, back into cash. These examples, hopefully that illustrated that. The first example was $43 million. Only put it in $10,000. Very confident that I'll be able to find somebody else to convert my shares back out when there's $43 million worth of deals going. $43 million worth of deals compared to just my $10,000 deal, no problem. I'm going to be able to convert those shares back into cash whenever I want to. Here, yeah, still possible, but not nearly as easy. All right, now let's talk about the rate of deals. Now this is just simply how many deals have been made. So in trading terms, and a lot of platforms, they'll tell you the number of trades, which is awesome. I love platforms that tell you just the number of trades, because it's a very easy way to figure out how many deals have actually been made. Now, how often our deals are made, this is where the tape comes into play. Every single little print that you see is some sort of deal. Yes, sometimes it can be one deal broken up into multiple deals, but they're just deals, and that's what they're counting as trades. So just visually look at the time of the deals. When I say the times, I mean, remember how we've had time A, time B. This is why in penny stocks it's important to look at those times. Now, are the deals happening every couple seconds, every minute, couple minutes, every couple hours, every few hours? This is why level 2s that show the time is very vital. So again, like the colors, they make things very easy in figuring out the size of the box. Level 2s that show times, very beneficial. Most, I believe, you may have to click a setting in order to see that. But with penny stocks, you really want to see, because sometimes you'll pull them up and they'll show you the tape. But if you don't know at what time everything's happened, then you can't really gauge the rate of deals. A good risk calculation routine is just this, what time was the last deal made? Look at your watch, and then what time is it now? And then how long has it been since then? So just let's make the math really easy. You pull up a stock and you see the trade has been, the last trade has been at noon. You look at your watch, it is now 1 p.m. Still no trade. You look at your watch, it is 1:30. Still no trade. And then boom, all of a sudden at 2 o'clock, you see something on the tape show up. So the last trade was at noon. This trade that I just saw was at 2 o'clock. There's been 2 hours since there's been a trade. Odds are that's not a very liquid stock. Generally speaking, the higher the rate of deals being made, the lower the risk. Generally speaking, from a liquidity standpoint. Now, this is important because you could have something where there could be just one massive order that comes through, and it's all done at one price, and it could be, let's just say, and this is just hypothetical, we'll take our example. So let's say there is a hedge fund wants to buy $42 million worth of shares, but that's just one deal. So if you were to pull up you look at it and say, all right, there's been shares traded, and you run the calculation, and it's, wow, $42 million. That's a lot of dollar volume. But in your calculation, you'd notice, wait a second, that was that was one order. That was just, you pull up the level 2s, and all you see on the entire tape is one order for 40, and it equates to $42 million. Is that a liquid stock? No. Is this a bizarre case? Yes, that's usually not the case. That's why I'm saying generally. So, but usually if there's a higher rate of deals, then you're going to be fine in terms of the liquidity. So the higher the rate of deals, the more deals being made at very quickly time periods, the lower the risk becomes, because usually that means they're liquid. But that's why the liquidity thing has 2 parts. First part, making sure that the dollar volume is there, but then you want to make sure that there's enough rate of deals, that it's not just some fluke type thing where there's just been 1, 2, or 3 kind of orders throughout the day that's generated all this volume. So keep that in mind too. And like I've already kind of started to establish here, vast majority of the time, a stock with high dollar volume is going to have a high rate of trades being made, and vice versa. So keep that in mind. Penny stocks are a crazy place though, so these 2 concepts need to always be addressed. What I mean by that is, I know I've spent lots of time on this, but in all reality, This can be done within a few seconds by looking at the scoreboard. So, looking at the tape, then looking at a quick, or maybe doing a quick calculation, and you're good to go. And some platforms, like I've said, will calculate the dollar volume for you. But yes, we've gone, let's see, it's 20 minutes in on this video, and we've pretty much just been talking about liquidity this whole time. So everybody thinking, wow, why is this such a complicated? No, just look at the scoreboard. You can do a quick mental calculation if you want, or if your platform gives you the dollar volume and number of trades, then boom, very easy. Look at that, determine, okay, how liquid is this? Now, what is liquid enough? That's a very good question. What is liquid enough? And this is just a case-by-case scenario. Think about it. Someone using $10 is going to have different minimums than someone using $100. Now, if you only had $100, for that example where it was $300,000, that's plenty liquid for you. You could easily get out $100 after putting it in to a stock that does $300,000. $10,000, a little bit different. And on top of that, at the end of the day, it's all about personal risk tolerance. Who knows? Who am I to say that $100 within $300,000 is okay? If I were to tell you that, and you're gonna start to get the shivers and sweat's gonna start to drip down your forehead, and you're gonna go into a corner and start shaking around and talking to yourself, then you know what? Maybe that isn't enough liquidity for you. So it's all about personal risk tolerance at the end of the day. So it's just general. That's just a thought exercise. But somebody with $10,000 and $100 is definitely going to have a different minimum that they need for liquidity. And then even within that, even if you had two people with $10,000 and two people with $100, they're going to be different because one amount may cause somebody to go start to talk to themselves and shake around in a corner, and then somebody else may say, oh yeah, that's no problem. That makes total sense. So remember, we're all human beings. We all have emotions, but we're all different in the sense of risk. A lot of people act the same, and human emotions are predictable, yes, but we're all definitely not the same when it comes to how much risk can we personally take on from a psychological level. And that's all risk is. It's how do we deal with it mentally. For me personally, $10,000 into a $300,000 stock, no way, never. But maybe there's somebody else that's saying, oh, I'll roll those dice. I like a little risk. That sounds like fun. Not me, but that doesn't mean it's right or wrong. It's just everybody's different when it comes to risk tolerance. But regardless, if you have $100, don't go and put it into a stock that has, a routine of $50 in liquidity. You will be trapped. That is a liquidity trap for you. That's not my opinion. That's just basic math. If you're putting a bunch of money into a stock that barely does any money, you're going to find out the hard way when it comes time to sell and convert those assets back into cash that you probably did a little miscalculation there. So we got the big first calculating risk thing out of the way. We have determined, okay, it's liquid. So that's the assumption we're going to make going forward, that step number one, priority number one of risk calculation has not only been done, but you've been able to put the little check mark in the box and it has been approved. So that's the assumption going forward. Now let's talk about the future friend rule. And this isn't, I just made this up because that's how I remember it. So hopefully I can convey it in the way that in my mind it works. So the future friend rule, what are we going to use this for? We use this to give you a quick and broad estimation of where you will be able to sell if you get into a trade. It's going to help you determine a risk versus reward visual. It's going to give you an idea. There's that word idea again. There is nothing exact, but it's going to give you an idea of when a good time to buy or sell is. And it cannot be used alone. So don't go and say, hey, I took ClayTrader's course and he taught me about the future friend rule. This is what I'm going to base all my trading on from here on out. No, that's not good. It needs to be used in conjunction with everything else you have learned thus far, and then even more stuff, which is not part of this course, but the more you know, the better. And really at the core, essentially, what you want to know is if you have friends watching your back when you enter a trade. Are you going to be good? I mean, is anybody looking out for you? That's what this rule is all about. Now, the first question to ask is, where do I want to sell a position or all of my shares for profits in order to accomplish my plan? I mean, basic trading is you need to have a plan when you go in. Part of the plan is, where are some of the areas you might want to sell? Obviously, you want to let the winners ride, but on that same token, you want to lock in some profit. So you need to have some sort of idea about that. So, got to ask yourself, what are your personal goals? Do you use charts? If so, where are the supports and resistance levels on the chart? What is the status of the penny stock equation? That's covered in a different course, but if you've taken that, ask yourself that. What's the status of the penny stock equation right now? How much risk tolerance can I personally take and still be able to sleep at night? So it's one of those things where it goes back to personal risk tolerance. If you're doing something and then you think, you know what, if I do this, I'm probably going to be laying in bed staring up at the ceiling all night, chewing my nails. It's probably not a good idea, no matter what everybody else is saying, because you're personally not comfortable with it. And that's fine, because at the end of the day, trading is psychology, and if you're going to drive yourself nuts because you're taking on too much risk or doing something where your mind doesn't psychologically like the risk, then it's not a good thing to do. So the answer to this question is going to give you just a reference point. It's not going to give you any sort of exact answer, just going to give you a reference point of what sort of risk you're staring at before you convert your shares into cash. That's the whole key here about risk analysis and these rules that we're going over right now. Is this is all happening pre-conversion of cash into shares. That's the beauty of level 2s, and that's what it's allowing us to do. Is we're not hopping in, we're not getting shares in our hands saying, well, my cash is gone, now let's figure out what. No, this is all done before you get in. So is it going to be a 100% success rate? No, absolutely not. But at least we're putting ourselves in a higher probable situation. We're getting ideals in our favor. Think about the graph we've looked at a couple of times, and that way hopefully raising our probability of success. So look at it like this. You need 3 friends to sell. So before you get into a trade, plan your risk based on whatever the price of the third MM is located at. What do I mean by this? Well, let's just take a little journey here. If you were to buy in, this assumes that you're highly motivated. So you're not partially motivated looking to buy in at the bid. You're highly motivated. You're willing to buy from the people up on stage. You're willing to slap the ask. You're willing to take the offer. Whatever lingo you want to use, that's what you're willing to do. But you are not partially motivated. You want to buy from somebody on the ask. So in this situation, you would come in and buy at 0.087. Now you need 3 friends to sell. So let's say you just say, you know, I want out right now. Can you get out right now by standing up on stage, putting your order in at the ask? No. If you want out right now, that means you're super motivated. Where do super motivated people sell? They sell it to people out in the crowd. What is the crowd? The crowd is the bid. So you need to do your calculation on the bid side of things. You need 3 friends to sell. So if you get in at 0.087, do not plan on getting out at 0.085. That's number 1. Don't plan on getting out here either. That's 2. Plan on and getting out at right here at the third MM. So if you get in at 0.087, you need 3 friends. Your third friend is sitting right there. So plan, you know, in a losing type situation, you're getting out at 0.08. So you pay 0.087. Where's your third ally? Your third ally, third friend, right there at 0.08. What is your risk? You can do the basic math. There is your risk right there. Is this acceptable? I don't know. I've already harped on the whole personal risk tolerance thing. It's all going to depend on your strategy, your goals, all that. So I don't know if that's acceptable to you. But the point being is, at least the level 2s are allowing you to make the decision for yourself. At least you have a context of what sort of risk you're looking at if you just automatically want to get out all of a sudden. So again, just want to make that very clear. You are motivated going in, so you're going to purchase from the offer. You're going to slap the ask, which is at 0.087. You automatically change your mind. Now you want out. If you want out, you have to hit the bid. You have to sell it to people out in the crowd. You need 3 friends. 1, 2, 3. So again, there is your risk right there. Kind of simple, but it's something that I guarantee a lot of people don't do. They don't consider it. They just look and then buy. The people that don't use level 2s have no idea, and they just look and buy. And as we're going to see in a couple examples, it's going to look like just almost complete suicide with how some things can actually appear and why. We'll just keep moving forward. So let's do a little quiz here. The future friend rule, what we just learned about. What do you see here in regards to future friends? I'm going to pause it, but just take a look at things. You're highly motivated. You're willing to buy at the ask. So doing that, you know, what's your risk going to be? All right, so would this be a possible good trade? I would say, yeah, pretty darn good. Why is that the case? Well, you are motivated, so you're willing to pay right here at 0.086. You need 3 friends to be able to sell in a worst case scenario where you automatically just want out. So 1, 2, 3. So your risk is not bad at all. I mean, you have 0.086 minus what you'd be able to sell there. Very nice risk versus reward here. solely from the three friend rule. Obviously, we have those other factors that we can factor in, but we're not talking about that. This is more for a mental exercise, just to get this point across that, you know, level 2s, you got to start to consider these things. Sure, we have VFin and Vert sitting right here, but that's none of that is the point right now. We just want to have a good mental exercise, a good framework of things you have to consider when you're trying to diagnose and figure out risk. So yeah, I would say that the risk, you know, yeah, that makes pretty good sense. I'd willing to buy off the offer there when you have, you know, you have quite a few friends behind you over here. Now, don't read any of this, but I want you to now go through the same exercise. So don't cheat. Don't read any of this over here on the left-hand side. But again, I'm going to pause it. Look at this and let me know your thoughts. All right. Does this make any sense right now to buy off at the offer? Well, let's take a look. If you buy here at 154, 1, 2, 3, and don't look at the amounts. Don't say, well, it would only be a 2-cent loss. Just look at it for what it is in terms of the structure of the level 2s. Does it make really any sense? I mean, to take a risk at 154. I mean, it blows my mind that there's people out there that don't use level 2s. They're going to happily buy at 154. And then they look at their future friends. They have one friend at 154.39 at this level. I mean, you've seen this example before, but why would you ever, you know, smack the ask when all you have is a future friend at the, you know, the tight spread level is just one. You have one friend there. Yeah, you have a bunch here, but that's besides the point. Like I said, it just, hopefully you see the lopsidedness of this. You have all these, and then you have one little friend right here watching your back if you get in at 154.39. Not to mention when you start to add in more things, they only want 5 shares anyways. I mean, you understand that, and I don't want to bring in other things since this is more of a mental exercise, but you know, when you bring in all the other factors that we've talked about, this makes no sense to go in and buy from the people on stage right now at 154. Yet, people that use level 1, they have no idea, so there's people buying at 154.40. Just no idea of the risk. I mean, it's not a logical risk right now at all to buy at 154.40. 154.40 is a massive area of resistance. And using your future friend rule, you notice you don't have many friends if you get in. You got one person watching your back right here. So it's terrible. And then when we now learn about the future enemy rule, I mean, this makes it even worse. I've kind of already spilled the beans a tad, but now when we factor in the future enemy rule, I mean, it's mind-boggling to me, you know, how much people are just really setting themselves up for failure by not using level 2. So the future enemy rule, it must be used in conjunction with the future friend rule. If you do not, you're not gauging total risk. So these two rules go hand in hand. Now, after you buy in, what kind of resistance from the enemies could be facing you? You know, again, this is certainly not exact. Mental exercise help to give you an idea of how to look at, you know, the level 2s. Is there a chance of progress? Is there any chance? More importantly, is there any chance of momentum? So that's what we're trying to figure out here. Looking at future enemies, is there going to be any sort of, you know, momentum or progress that could potentially be made? So the best way to do this is count 4 MMs. Now, maybe it's 3 for you. Maybe it's 5. I don't know. This is 4. That just makes sense to me. I would say start out there and, you know, watch level 2s. And if that, you know, if that floats your boat, then go with it. But this is why I love the market, why it's a beautiful thing. There's a million ways to skin a cat. So if you don't agree with that 4, or on the future friend rule, if you don't want to use 3 and want to use something else, then more power to you. The point here, though, is, like I said, the mental exercise, the mental kind of wiring that we're doing in our brains on how to look at this stuff and how to look at where is the market and where is kind of the future market. And that's what this is. So for me and for this, we're going to just count 4 MMs, and that includes the best ask. So you include the inside ask, and then see where the price is at now. Is the price different? If it's not different, then there's not the odd. I'll never say impossible, but there is less odds, less probabilities of momentum getting started. But if it's yes, and there's not as many future enemies, then yeah, there's momentum possible. So let's take another look at this with our examples here. So going back to this example here, let's count our future enemies. You would be buying at 0.087. So 1, 2, 3, 4. So 0.09, you're getting in at 0.087. You know, yeah, there's there's some progress being made. I mean, 0.087, 4 MMs away, enemy wise. Okay, you still have some sellers here. So yeah, there's some potential progress here. I mean, it's nothing that's really getting me excited or anything like that. I mean, I wouldn't call it a terrible entry, but you look at the, going back to future friends. So you'd be looking to get out over here at, if you decided to use 4, so let's say you wanted to use 4 MMs for your future friend rule. I mean, that puts your risk much more because the next MM isn't at 0.065. So 0.065, if you're counting on getting out, but in terms of future friends, only getting up to 0.09, I don't really like the risk versus reward. But that's using 4. If you're using 3, still decent, but point being, nothing sticks out obviously to me here. I mean, it's not obviously a bad decision, but it's not really obviously a good decision. So to me, it's kind of neutral. And when it comes to neutral, I'm just really not interested. All right, now take a look at this one, run the calculation, and we'll be back and talk about it. So what are you thinking? Does this look like a decent logical area to take some risk if you want to take the offer? Well, let's count our enemies. 1, 2, 3. All right, 0.095. And if you're looking to get at 0.086, that's almost a whole penny move. And then you factor in our future friends, which we've done. You know that you're right here. And look at this. You actually have another little layer of protection here at 0.085. So to me, I like this setup here. More things to consider. Again, I mean, we're not talking about yet. Sure, there could be potential dilution. And yes, if there's dilution going on, then, this changes the landscape. But I keep repeating this, but I want to just drive home. We're just looking at this as a mental exercise, get you to start to visualize kind of how to look at things and how to plan and try to calculate some, a broad and quick sense of risk. So, but again, I love this one. Like I said, 1, 2, 3, 4, bam, 0.095. So certainly some progress, and then certainly a ability to get some momentum built. I mean, if the price really starts to get up there, if the tape shows a bunch of people starting to buy from the people up on stage, so you have all those green orders coming through on the tape showing ass slap, just hit after hit, not too bad. Yeah, sure, some momentum could get started. And then on top of that, using the 3 friend rule, not only are you here, but you actually have somebody else that's still at that price, so you have a little buffer of protection right there. So this is a very nice setup. Now let's come back to this one. Let's go through, actually you go through it and I'll pause it and then we'll come back and chat. All right, so looking at this one, let's just do this. You buy here, let's go for 1, 2, 3, 4. Right here, you're at 154.40. You still have 1, 2, 3, 4, 5, 6. 6 to go, 6 more enemies to go, even after forecasting out 4 enemies. And remember the future friend rule. How many friends do you have at that initial level right there? 1. So I hope you see now how much of a terrible decision this would be to pay 154.40 at this moment in time. Remember, this is just a snapshot. They're going to be changing, but at this moment in time, does it make any logical sense to buy off the people on stage for 154.40? No, I mean, that's just a terrible choice, especially when you start to use it in conjunction with the other things we've been using. I mean, it just makes no sense. So I've already kind of covered this, but if you ask yourself, why does this level 2 suggest that the risk is not in your favor? I really hope that's abundantly clear, especially when you combine future friend rule, future enemy rule, and then start to bring in other things, just the size of the box, the order sizes. I mean, it truly makes no sense. You bring in the order sizes and you look here, look at the size of all these orders, and you may be thinking, well, yeah, but look, you have all these future friends here. Well, look at the size of the orders of the future friends. Yeah, you got 140 there, but that's nothing compared to what's being offered over here. And again, the crazy thing is that just blows my mind is not using level 2, people would have no idea about this. They would see on level 1 maybe 154.40. Bam, I want in at 154.40. Wow, as a trader, that is just not a good entry point. Again, don't look at the prices. Don't think, well, geez, I could still get out for it. And it just, even if I sold way down here, that's still 3 cents. That's only a 3 cent loss. That's not the point. The point is the structure of the market. The structure of the market says, yeah, a lot of bearishness up here. That's what I want to focus on. So don't look at the prices of these things, but wow, to think that people are trading penny stocks, without level 2 and having no idea on the structure of the market with things like this, and they could be missing out on just obvious non-risk favorable situations. It's crazy to me, and why it's true. People truly say, you're trading blind without level 2 because you would have no idea about this risk scenario. And again, risk is not in your favor in this scenario at all. So generally speaking, now we're hanging out, you're sitting next to me, so am I turning and saying to you, hey, I expect you to sit here and count MMs all day long and no trading. I just want you to count MMs. No, that's not what I'm saying at all. That's not the point of these rules. The point is to get you to understand that upon looking at the box, what is the future ratio of friends to enemies? That's what we're doing. Again, I've used the word before, and I'm going to use it again. We're all about comparing. We need to know the ratio. Buying into a stock with a small amount of future friends compared to a big amount of future enemies is not a risk favorable entry point, and then vice versa is true. But again, highlight this if you printed them out, memorize it. Buying into a stock with a small amount of future friends compared to a big amount of future enemies is not risk favorable. Vice versa would be buying into a stock with a big amount of future friends compared to a small amount of future enemies. That is a risk favorable entry point. Is it a guaranteed opportunity at profit? No, but is the favor, or is the risk at least in your favor? Are you mitigating risk? Are you limiting risk? Are you tilting probabilities into your favor? Yes, you are. Could you do any of this without level 2s? No. So that's why level 2s are so important. Okay, you're probably thinking, okay, relax. You're raising your voice. You're letting the adrenaline go again. You're right, I'm passionate, but this is just important stuff that so many people miss out on. So maybe, when is a good time to make your move? Good question. Let's talk about that. And you're probably not going to like this answer, but it's the honest answer, though, so that's what I'm going to give to you. It's just a case-by-case scenario. All depends on how much risk you can psychologically withstand. We've talked about that many times. I do not want you to get the cold sweats, the shivers, to go sit in a corner and start talking to yourself. I don't want that. I want you to be a successful trader, and I don't consider a successful trader as having those attributes. But a general rule, and I'm emphasizing this, don't go and just start doing this, and then if it doesn't work, hey, your stupid rule didn't work, I lost money. It's just a general rule. Again, a mental exercise just to get your eyes to know what sort of look for. But when the future enemies are half of what your future friends are, I like it. It at least makes sense. So what do I mean by that? Let's say there's 8 MMs on the best ask. So they're all lined up. They want to sell at 10 cents. And then the ask starts to get hit. The risk becomes more and more favorable because as the ask is getting hit, the MMs start to drop off. At the point there's just 4 MMs left on the ask, okay, now you have 8 MMs on the ask, on the bid, and you have 4 MMs on the ask. Who has more friends compared to enemies? You're going to have a lot of friends. You're bringing more people to the brawl is the bottom line here. Is the person who brings the most people to the brawl usually wins. And that is what we want to do with trading. We're like street fighters. We just want to bring a lot of, it's like, meet me at the flagpole at 4 o'clock. We're going to have a brawl. Well, you better bring some friends because they're going to bring friends. Whoever brings the most friends normally wins, unless the other team brings like a couple Navy SEALs, then yeah, that's a little bit different. But under a normal situation, whoever brings the most friends wins, and that's what we're trying to do here. So again, just a general rule, the general philosophy, you want more friends than what you have as future enemies. But the great news, again, is all this is done before you convert your cash into shares, which is good. No guarantees, that's why I say usually, you never know, maybe Navy SEALs will show up, but as just, a mental time frame on thing, that's something that you need to keep in mind. Another thing is ask slapping doesn't have to happen. Let's say in this situation, there's 8 MMs on the ask, 8 MMs on the bid. Then let's say all of a sudden the bid grows and now there's 16 MMs on the bid. According to this general rule, okay, now I like it all of a sudden. Why do I like it? Well, your friends just grew from 8 to 16 and the ask is still sitting at 8 MMs up there. So not a guarantee, but hey, you're going to be bringing quite a few people to the brawl. So, things become a little bit more risk favorable. So just keep that in mind. All about knowing who your friends are and knowing who your future enemies are. but you have a great idea of that. Not a for sure idea, not a guaranteed idea, but you can at least estimate and get a general gauge of these questions by looking at level 2. Don't be one of these people that are using level 1 and then buying into that one example where you had like 30 different people at one price level and then one friend watching your back. Makes no sense. But at the end of the day, step number 1, do not forget it. What was step number 1? Nothing in this course matters if you skip over this first step and disregard liquidity. I will walk, drive, fly, swim, ski, parachute, dig, climb to wherever you are and slap your hand if you skip this first rule. If I hear about you disregarding liquidity, not figuring out what the dollar volume is, I'm going to find you and I'm going to come slap your hand. I don't care how attractive, how beautiful, how stunning the level 2s look. If liquidity does not meet your specifications, then don't take any part in it. It doesn't matter. Nothing matters. Save yourself some time. Go do something else that you enjoy doing, but don't spend your time trying to analyze risk on level 2s because you're already staring down the biggest risk mitigation factor, which is what is the liquidity. If you want to avoid risk, the biggest risk mitigation factor is liquidity. So do not skip over on it. And always remember, a trade is 2 parts. Just because you can buy those shares, especially in penny stocks, boy oh boy do those penny stock CEOs love to sell you some shares. Those financiers love to sell you some shares. They love to take your cash, but that doesn't mean you can sell. A transaction has 2 parts. You need somebody to buy it from you. So there needs to be a buyer, somebody that's going to shake your hand and make the deal with you. If you don't have that, then you're at a high risk already, and it doesn't matter what the level 2s look like. So don't disregard liquidity. I don't want to have to find you and slap your hand, okay? I have better things to do, but I will because you're being stupid. You're being an idiot. Let me just talk straight to you. Friend to friend, you're being a complete moron if you disregard liquidity because that is the best way to get yourself into a liquidity trap, and liquidity traps are extremely high risk. And by the time you're in a liquidity trap, it's too late. Why is it late? Because you've already converted your cash into shares. But doing this, going through step 1, is going to prevent that, and then going into all these other steps will at least give you the best possible scenario to hopefully have some success. So hopefully I've driven that across enough, but calculating your risk or calculating your entry point and exit points, all going to be based where your friends at, where your future enemies at. Can some progress be made? Factor in all those things, and then factor in everything else we've been talking about, and you're going to be well on your way to getting some good logical entry points. I want to end on that one where you had all those market makers on the sell side. That's what you want to avoid. It makes 0 sense from a risk perspective to buy in at that level. That's what we want to avoid, and that's what level 2s are going to allow us to see and do.